All right, welcome everyone. I hope you're enjoying the conference and have tried the networking portion of the platform. So my name is Marcus Schrott. I am BC Interior's leader for not-for-profit and education group at BDO. And it is my pleasure to introduce our next speaker, Ken Garth. So Ken is a tax partner who specializes in GST and HST. He's based in Bracebridge, Ontario, and works with a variety of personal and corporate tax clients, as well as not-for-profit organizations and registered charities. So I just want to remind everyone, if you have any questions at any time during the presentation, please submit them through the chat feature, and we'll leave the last 5 minutes to cover any questions that you may have. So without further ado, Ken, I'll pass the stage over to you.
Thanks, Marcus, and thanks for attending, everybody. So yeah, I'm going to speak to some GST and HST issues that charities and not-for-profit organizations may be facing. I think it's pretty safe to say that in March of 2020, a lot of charities and NPOs had their world sort of turned upside down, and a lot of their traditional funding sources dried up overnight. Now, these organizations have been spending the last few months trying to come up with new revenue sources and new fundraising ideas to replace those lost funds. But one of the things we're finding is people are not considering the sales tax implications, and specifically, do we have to worry about GST or HST? Now, just to preface everything here, I'm going to use the terms GST and HST interchangeably. It's the same tax. It's, just whether it's 5%, 13, or 15, depending on where you are in Canada. But when I use GST and HST, you can consider them the same thing, just to avoid any confusion. Just FYI, I'm in Ontario, so if I have some Ontario examples here, that's why. So what we're going to talk about, basically 3 different areas. Number 1, registration for GST. When do you have to register? Then we're going to look at charities and not-for-profit organizations and what sort of supplies are taxable supplies requiring you to collect GST, and what supplies are exempt and how they're different for the 2 types of organizations. And the last section is going to talk about if your organization is registered, what sort of other considerations do you need to keep in mind? So without further ado, so let's talk about registration. A lot of times we're speaking with an organization, we say, one of the first questions we have to ask is, are you registered? And the answer we quite often get back is, yes, we are. Well, a lot of times they're in fact not registered. Organizations that claim rebates, like the charity or public sector body rebates, may have a public sector body rebate account number assigned to them by Canada Revenue Agency. Now, unfortunately, this number looks exactly like a GST registration number, but in fact, it's not. So it's important to understand whether you actually are registered or not. You can check for sure by looking online. Canada Revenue Agency has a GST registry. And you can go online, put your organization's information in, and find out if you are actually registered. And that's important to know, because if you are registered, you do have to collect HST on all of your taxable supplies that you make. So why do we care about distinguishing between charities and NPOs for GST purposes? Well, simply put, the rules are very different. Charities have their own set of rules. There's some supplies that are exempt when a charity makes them, and they might be taxable when a not-for-profit organization makes them. Their rules for claiming rebates are different. So it's really important to know what kind of organization you are. And just to make things more complicated, there's a third kind of organization called a public institution that we'll just touch on briefly, and it's kind of a hybrid of the 2. So let's look at when you have to register. If you are what's called a small supplier, you're not required to register. You can do it voluntarily if you want to, but once you cease to be a small supplier, you are required to register for GST. Now, for a charity, the tests are different for other types of organizations. So a charity has actually 2 thresholds that they have to be over, and you have to be over both of these thresholds before you're required to register. The first one is having taxable supplies in excess of $50,000, and we'll talk about what some of those are. And you need to have total revenue from all sources, so including donations, fundraising, taxable exempt supplies, and everything in excess of $250,000. So once you're over both of those, you are required to register. Now, for not-for-profit, including public institutions, other kind of organizations, you just have the 1 small supplier test, and that is having taxable supplies in excess of 50,000. So again, once you're over that, you need to register. So if we look at the concept of taxable and exempt supplies, and simply put, a taxable supply, if you're registered, you need to collect and remit GST or HST on them. An exempt supply, you do not have to collect tax. The rules for charities are quite different. So charities have what's sort of referred to as the general exemption, and it's this very broad and overriding exemption that essentially says all supplies of property or services made by a charity are exempt, with a few exclusions. And some of the exclusions I've just set out below there. We've got a sale of property or equipment or other assets that are used in a taxable activity. Sale of goods that were acquired or manufactured by the charity for the purpose of making a resupply of them, but they exclude donated goods or used goods. So if you buy something and resell it, that's taxable. But if someone donates something to a charity and they resell it, that's exempt. Now, real property, in most cases, supplies of real property, either by lease or sale, are exempt, but there are a few situations where they could be taxable. So I'm not going to get into those, but you just do have to be aware that they can be taxable in some situations. Admissions to a place of amusement, that would be somewhere where it's like a sporting facility or a gala or a show or some sort of entertainment event. Memberships, many memberships are exempt unless they provide access to sporting facilities or recreation facilities and some parking. So you can see that many supplies made by a charity are exempt. Now, not-for-profit organizations, on the other hand, they don't have that sort of general broad overriding exemption. So a not-for-profit organization is much more likely to be making taxable supplies. So if you are an NPO, it's important to look at all of your revenue sources carefully and just make sure that if there are any that are taxable, you're picking that up. So a lot of times we find because NPOs don't have as many exemptions available to them, sometimes they are required to register and they're not. So if we look at the exempt supplies that an NPO can make, the rule is sort of the reverse of the charity rule. So basically it says that all supplies that an NPO makes are taxable unless we have a specific exemption that causes it to be exempt. Now, having said that, there are a fairly large number of supplies that are exempt, and you can see a list here. So some volunteer fundraising, so selling goods under $5, bingo or casino admissions, supply of goods for a charge not exceeding their direct cost. So if I buy a t-shirt for $20 and sell it for $20, I'm not selling it for an amount in excess of direct cost, so that's exempt. But if I buy it for $20 and sell it for $25, that's a taxable supply. Amateur performances and events, you can see there. So if somebody is attending their kid's hockey game or they're attending an amateur theater production, that's normally exempt. Recreational services and camps for children or disabled or underprivileged individuals are exempt. Some memberships, again, a lot of memberships, we'll touch on this on another slide, but a lot of memberships by an NPO are in fact exempt, but there's situations where they can be taxable. Again, there are supplies of real property that can be exempt, but it's not as generous or as broad as the exemptions that are available for charities. So you can see there are a number of supplies available for NPOs, but certainly not as many as there would be for a charity. Now, I mentioned about that third kind of entity, a public institution. I won't spend too much time on them, but just to understand that an organization that is a registered charity and also some other kind of entity like a school authority, public college, university, or a hospital authority is considered to be a public institution. And the rules for exemptions are kind of a mishmash of the charity and the NPO rules. So they do have sort of an overriding exemption, again, that says supplies of property or services are exempt, and the exclusions are similar to those that a charity has. The big difference is with respect to real estate. So land and buildings, real property, is treated like an NPO, not like a charity. There's also exemptions available for some fundraising activities and a few other things, plus all of the exemptions that are available to a regular not-for-profit. So you can see how public institutions, not quite there for charities, but a lot closer. Now, one of the items I did want to discuss specifically was the issues of grants and funding, because this is something that comes up quite a bit. And a lot of people make the assumption that if they're getting money from a government, it's not taxable. And that's not always the case. So you really have to distinguish between whether what you're getting is a tax-free government grant or subsidy, or is it a taxable fee-for-service arrangement. So, normally a grant or subsidy is not taxable because it's not consideration for a supply. You're receiving money from a funding organization, but you're not making any return supply to that organization, or you're not doing something on their behalf. What you have to distinguish that between is a situation where there's a link to the funding that you're getting and you performing either, like I said, providing something back to the organization, or perhaps you're doing something that they would normally be required to do and you're sort of performing that on their behalf. So if there's that kind of a link, you have to look at the agreement carefully, determine that it could be in fact a taxable fee for service arrangement, and it's something that does come up from time to time. So don't always assume that just because the money's coming from a government source that it's in fact exempt. So I just wanted to walk through a few examples of taxable and exempt supplies and just sort of show you how they apply to charities versus NPOs. Whoops. So first one is golf tournament fees. So let's say we have a charity, they're putting on an annual golf tournament. So we look to remember the general conditions for the general exemptions for charities, and we would say, well, a golf tournament, playing on a golf course is an admission to a place of amusement, and that was one of the things that was carved out of the general exemption. But then we look at some of the other exemptions that are available for charities, and there's one for non-recurring fundraising. So this is an event that doesn't carry on throughout the year. So normally it would be exempt based on the non-recurring fundraising rule. There's also a rule that says if the person purchasing the golf tournament ticket gets a charitable donation receipt for part of their fees, that also exempts the entry fee. So you can see in a lot of situations, an admission to a golf tournament is exempt when a charity puts it on. Now, if we look to the not-for-profit organization, if we remember, we had those very specific exemptions that were available, and none of them would cover this off. So typically, a golf tournament put on by a not-for-profit organization would be taxable. Memberships, again, we touched on memberships, and generally memberships in a charity are exempt unless they provide access to recreational or athletic facilities or events. For a not-for-profit organization, again, many of the memberships are exempt, but the criteria are a bit different. So if the organization provides discounts or makes available other significant benefits to members, they could be taxable. Or if they provide them with access to dining or sporting facilities, they would be taxable. But the other big difference is a not-for-profit can actually file an election to make their memberships taxable if they would otherwise be exempt, and charities can't do that. And we'll touch on that a little bit later on, because that sort of raises up some possible opportunities for an NPO. Now, if we look to a silent auction, again, for a charity, if you recall, one of the exemptions was, if we had goods that are donated to the charity and resold, those are eligible under the general exemption for charities. And that's the case with most silent auction items. Now, if the charity actually purchases items and then resells them, those are kicked out of the general exemption. So you have to be a little bit careful. Maybe if it's a silent auction that only occurs once a year, we could get that under the non-recurring fundraising exemption. But that's just something to watch for. Now, for a not-for-profit organization, generally the sale of the goods are going to be taxable. So there's no fundraising exemption or anything similar to that. So you do have to be aware for an NPO that this could be taxable. Now I'm going to skip the next couple here just in the interest of time and move to the next section, which is, let's say that your organization has determined that you do have to register. So now you've become registered. This puts us into a few other situations or things that you need to be aware of, and I just wanted to touch those for you. So first off, your public service body rebate applications that you file. So charities and some not-for-profit organizations do file for rebates. If you're not registered, you file these rebates on a 6-month period. So twice a year, you're filing your rebate applications. As soon as you become registered for GST, your rebate filing period has to match your GST return filing period. So that could be monthly, quarterly, or annually. So that's just something to be aware of, that it will change your filing frequency. If you do have rebates or tax that you've paid in a particular period, they did recently change the rules and allow you, instead of having to claim it only in the period that you paid the tax, you also can claim it on any return filed within 2 years and 3 months. So that was a nice concession they gave a couple of years ago. Now, for charities that are registered for GST, this only relates to charities, not for NPOs. There is a special tax reporting method that they have to use, and I think a lot of people are not aware of this. So a regular business like BDO, for example, we collect tax, we charge it at 5 or 13 or 15%, and report that on our return as tax collected. We pay tax on all of our inputs, and we put that as input tax credits. We net the two out, and whatever the resulting number is the tax that we send in to the government on our GST return. For a charity, they're required to use what's called the Simplified net tax calculation method. It's a bit of a mouthful, but and basically it works like this. So if the charity is making taxable supplies, they still charge and collect GST or HST at 5, 13, or 15%. But when they're reporting that tax collected on the return, they actually only report 60% of the tax that they've collected on the return as being collected. The other 40% they're actually allowed to keep. So that's a big benefit. Now, for input tax credits, they're generally not able to claim any input tax credits, even if they're for something used in their taxable activities, except for purchases of capital property, so equipment or real estate, that kind of thing. That's used primarily in the taxable or commercial activities, so more than 50%. Anything else for tax paid, they just claim their regular charity public service body rebate. So it's 50% of the GST. In Ontario, you get 82% of the provincial component, but that will vary depending on where you are in Canada. So again, with this simplified net tax calculation method, charities are required to use it. It's not optional. Now, in some situations, you're allowed to elect out of it, but in order to elect out of it, if you want to, the charity has to either make supplies outside of Canada or make zero-rated supplies in the ordinary course of their business, or more than 90% of their supplies have to be taxable supplies. Those are situations where you don't ordinarily see charities fall into. But it can happen from time to time. But if you don't meet the criteria and you can't elect out, then you have to use this method. Now, this actually presents a bit of an opportunity for charities, because when you run the numbers, a lot of charities are actually quite a bit better off by using this method because of that 40% of the tax that you're allowed to keep, compared to having to remit all of the tax you collect and then claim input tax credits. Now, if your charity isn't using this method and you were required to, you're actually able to go back for the last 4 years of returns and file an amendment to the return and ask them to apply the correct filing method. And quite often what you find is that it results in quite a bit of a refund coming back to the organization. So it could be a good opportunity for a lot of charities. Now, the membership issue here, this one is applicable only to not-for-profit organizations, not available to charities. But again, we've talked a little bit on memberships and when they're taxable. And again, typically NPO memberships are exempt unless it's something that, a club that's providing dining or recreational or sporting facilities, or making other certain benefits available to members. So, if we're in a situation where our membership fees are exempt, a not-for-profit organization can actually file an election to make their memberships taxable, even if they would be otherwise exempt. So again, charities can't do this, only a not-for-profit. Now, you might think of, well, why would I want to charge tax on my memberships? Well, if you're making your memberships a taxable supply, if your members are primarily, businesses or other people who are registered for GST and able to claim input tax credits, they're going to recover all the tax they pay on the membership fee. So they're probably going to be indifferent as to whether or not they have to pay the tax. But on your organization side, once the memberships are taxable, any HST or GST that you pay on your inputs to providing those memberships is now eligible to claim as an input tax credit. So you can get it back. which can provide a pretty significant benefit. If, in Ontario, you could cut back a lot of your operating costs by 13%. So it's something that's, it's an opportunity that's available, but you definitely want to consider the impact on the members and whether or not they would be able to recover the tax. Now, this next opportunity is one that's available to both charities and not-for-profits, and it's called the Section 211 election. And it relates to real estate, or real property as they call it for GST purposes. So generally, we looked at some of those exemptions and so on, and quite often supplies of real property made by a charity or not-for-profit, either by lease or by sale, in a lot of cases, they're exempt. Now, if we're a registered organization and we're looking at, having purchased property and paid tax, there's a kind of, they call it the all or nothing rule that applies. And it says, if you've purchased real property or done an improvement to real property, you can only claim an input tax credit if it's used primarily in your commercial activities or more than 50%. If it is, then you get a full input tax credit, so you get back all the tax you paid. But if it's not used primarily, so if it's used 40% in a commercial activity, you get none of the HST back as far as an input tax credit. Whether you get a rebate is another question. So this 211 election has two impacts. So number one is, once you file this election on a piece of property, any supply of the property, so whether you lease it out to somebody or whether you sell it, becomes a taxable supply. So now you're going to have to charge HST on it. But it also eliminates that all or nothing rule. And now your ability to claim an input tax credit depends on the extent to which you're actually using the property in commercial activities. So if you're using it 40% in commercial activities, then you can claim 40% of the tax you paid on your purchase or your improvements to the property as an input tax credit. Now, this one requires an election form to be actually filed with Canada Revenue Agency, a GST 26, and you have to file the form at the time you're making the election. Now, just to show you how someone can benefit from this, let's just take an example of of a charity that purchases a building in Ontario for $500,000, and HST of $65,000 is paid on the purchase. Now, the charity, if assuming they're not using it in a commercial activity, they're able to claim their charity rebate and get back about $45,000 of the tax. So there's about $20,000 of the tax they paid that they can't recover. So now in 2020, we're going to be selling it to a developer. The developer's registered for GST. The developer is going to be indifferent as to whether or not they pay tax. So the charity can do one of two things. We can not do anything, sell it on an exempt basis, and just carry on with our lives. Or we can file this Section 211 election before the sale to make the sale taxable. And what that does, again, the developer gets back the tax that they'll pay, so they don't care. But what it does is it allows us to claim that extra $20,000 that we didn't get prior or previously as an input tax credit. We can actually now claim that to recover it. So there's a $20,000 benefit to the charity to making that election. It also works in situations where you're leasing the property too. And the last item I wanted to touch on just before we move to the Q&A section is an issue or something to be aware of when you are a charity or an NPO. You're registered for GST and you're purchasing real property. So there's a special rule under the GST where you're buying real property and the purchaser is registered for GST. They don't actually have to pay the tax to the vendor. What happens is the purchaser is responsible for self-assessing or effectively charging themselves the tax on their own GST return. And then they have to look at whether they can recover any of that tax as an input tax credit or a rebate. In a lot of cases with a charity or an NPO, you don't get a full recovery of the tax. So what happens when you do this self-assessment is you may end up on the hook for paying some portion of the tax. Now, it's really easy to miss this self-assessment requirement because it's just, quite often the lawyers are doing the purchase and they say, oh, you're registered, you don't have to pay the tax, and it all kind of falls off the table. But the risk is that if you don't do the self-assessment, or if you do it, you just have to be aware that there may be some portion of the tax that's not recoverable depending on the use that you're making. And just to put this into some dollar figures, let's say, again, we have a charity in Ontario that buys a building for $5 million. They're not using it in a commercial activity, but they're registered for GST. So the tax that they are required to self-assess on the property is $650,000, 13%. And let's say they forget to do this and CRA auditor knocks on the door and they say, look, we're doing an audit, and they discover that they weren't able to self-assess. What would happen is the charity would be required to self-assess the $650,000, but they would only get a rebate of $453,000 through their charity rebate, leaving a net liability of $197,000. So you just have to be aware, if you are an organization that's registered, you're buying real property, you really need to consider this rule and see how it's going to affect you and whether you need to budget for some extra tax. So that's all I had as far as the slides go. And I think we have some questions now. So I want to take the last couple of minutes to just try and address any of those that we've got. Marcus?
Great. Thanks so much, Ken. That was great. Yeah, so a lot of questions coming in. So I'm going to say we're going to try and tackle a few of them before time runs out. But if you have any other questions, please reach out to Ken or anyone on the BDO team to help you out. So we'll start off with a charity one. So the question is, are camps run by a charity exempt? So I'm reading between the lines, maybe the fees to attend a camp, are those your HST exempt?
Yeah, typically they would be. Yeah, they would sort of fall under the general exemption and so on. Yeah.
Okay, great. Start off with some easy ones.
Actually, sorry, I should. Well, and I guess if it's a children's camp, right? So there, I just want to. There are some situations, I guess, where camps for charities could be taxable. I know we've looked at some before. It may depend a little bit on. You know, some of them are a place of amusement and stuff. So I guess I shouldn't say it's a blanket yes. In some cases they are. But you know, I guess you'd have to look at the specific facts around that one to make 100% determination.
Okay. Okay, great. So this is another one from a registered charity. So if a charity runs a plant sale once a year, I gather it's a fundraiser, would it be taxable?
And I guess you have to look and say, were these items, now, I guess if it's a once a year fundraiser, even if we don't get on that, you know, if the goods weren't donated to the charity, let's say, if it's a once a year fundraising, then there's a non-recurring fundraising exemption that you'd usually cover those off. So as long as it's not something you do on a regular and continuous basis throughout the year, then typically that non-recurring fundraising exemption would cover that off for a charity.
Okay. Great. That's great. So I have another question that deals with the selling goods across the country. So this question comes from Brent. We're an Ontario charity and we sell across Canada. So do we need to register with provinces that have their own sales tax system, like Saskatchewan, I guess, if we are selling and shipping from Ontario?
So for the provincial sales taxes, in some cases you might. Each of the provinces, so the ones that have a provincial sales tax are BC, Manitoba, and Saskatchewan. So Alberta has none. And a lot of the eastern provinces use the harmonized tax, and then Quebec has their own tax, which is similar to GST, but it's not exactly the same. So if we're looking at BC, Manitoba, and Saskatchewan, they each have their own provincial sales tax, and the rules, while generally kind of similar, they're not exactly the same. Some of them look at whether or not you're actually soliciting directly to people in that province for sales. If you're not, and don't take me completely at my word here, but BC and Manitoba, I believe, if you're not soliciting directly to people in the province and you're not in the province and don't maintain goods there, then in some cases you don't need to register. In Saskatchewan, I believe you do, and there's no sort of small supplier threshold for that. And I also believe that BC is changing their PST in the next little bit, so you might have to keep an eye on that, but certainly it is a concern. You definitely have to watch it. That's why the GST and HST is so nice, is it's the same rule applied everywhere in the country, right? Mm-hmm. It's just the rate you need to worry about. So you definitely, it could be a concern, probably mostly in Saskatchewan and potentially BC coming up.
Great. Okay, Ken, I think we maybe only have time for one more question. So I know there was a bunch asked, so apologies, we aren't able to get to all of them, but it's a question. So if a charity sold masks as a revenue stream, would that be subject, or would that be taxable?
So I guess a couple of things you need to look at. So let's just assume it's not non-recurring fundraising. So it's something that they're doing throughout the year. If they purchase the masks and they are then reselling them for a profit, then you wouldn't fall under that general exemption, and you might have to look at yeah. So if they were donated, like if someone gave them a box of masks, then they turned around and sold those, that would fall under the general exemption. But if you're buying something for the purpose of resale, you would definitely need to look at it. You know, it could be a taxable supply. And then, you know, if you're a small supplier, maybe you don't need to register, but you definitely have to look at that.
Excellent. Great. No easy answers to some of these questions. So anyways, I think
the answer is always it depends.
Yeah. Okay. I think that's it for time. So I just want to thank everyone for being here. So it's great. So please, by all means, reach out if you have any questions at all. Thanks again, Ken, for sharing your wisdom with us. So we're taking a 5-minute break before our next session. So we'll see you all at the virtual networking. Thanks so much.
Thanks, everyone.